Imagine you're standing at the edge of Wall Street, watching the hustle and bustle of traders, investors, and speculators. Some are making fortunes, while others are losing everything. The question on everyone's mind is, how can I beat the market? This is the story of A Random Walk Down Wall Street by Burton G. Malkiel, a book that takes you on a journey through the history of investing, the madness of crowds, and the theories that attempt to explain how markets work. It's a story of hope, greed, and the eternal quest for financial success. The two theories of investing, firm foundations versus castles in the air. Let's start with the two main theories that have shaped how people think about investing. The first is the firm foundation theory, which argues that every investment has an intrinsic value based on its fundamentals. Things like earnings, dividends, and growth potential. Think of it like buying a house. You want to know its real value before you pay for it. Investors who follow this theory believe that if they can calculate a stock's true worth, they can buy it when it's undervalued and sell it when it's overpriced. The second theory is the castle in the air theory, which is all about psychology and speculation. This theory suggests that investors should focus on predicting what other investors will do, rather than worrying about a stock's intrinsic value. It's like building a castle in the air. You're betting that others will keep building it higher, and you can sell before it collapses. This theory was famously championed by economist John Maynard Keynes, who compared investing to a beauty contest where you're not picking the prettiest face, but the face you think others will find. Prettiest, the madness of crowds, tulip bulbs, bubbles, and booms. Now, let's dive into some of the most famous examples of market madness. These stories show how easily people can get caught up in speculative frenzies, building castles in the air that eventually come crashing down. The tulip bulb craze, 1630s. In 17th century Holland, tulip bulbs became the hottest commodity in town. At the peak of the craze, a single bulb could cost as much as a house. People were trading their land, jewels, and even their furniture for these bulbs, convinced that prices would keep rising forever. But in 1637, the bubble burst. Prices collapsed, and many investors were left with nothing but worthless bulbs. The tulip craze is a classic example of how speculation can lead to irrational behavior and financial ruin. The South Sea bubble, the 1720, fast forward to 18th century England, where the South Sea Company promised investors untold riches from trade with South America. The company had no real profits, but that didn't stop people from buying its stock. Prices soared, and even Isaac Newton got caught up in the frenzy. But when the bubble burst, Newton lost a fortune and famously said, "I can calculate the motions of heavenly bodies, but not the madness of people." The Florida real estate craze, 1920s. In the 1920s, Florida became the center of a real estate boom. People were buying and selling land at astronomical prices, convinced that the Sunshine State was the next big thing. But by 1926, the market collapsed, and many speculators were left with worthless properties. This was just a prelude to the even bigger crash that would hit Wall Street in 1929. The Roaring Twenties and the Great Crash, the 1920s, were a time of unprecedented prosperity in the United States. The stock market was booming, and everyone seemed to be making money. But beneath the surface, there were signs of trouble. Companies were overvalued, and investors were buying stocks on margin, borrowing money to invest in the hope of making even bigger profits. In October 1929, the bubble burst. The stock market crashed, and the Great Depression began. Billions of dollars were wiped out, and many investors lost everything. The crash was a stark reminder that markets can be irrational, and that speculation can lead to disaster. The Nifty 50 and the go-go years, 1960s, 1970s. After the crash, investors became more cautious. But by the 1960s, a new speculative frenzy was underway. This time, the focus was on growth stocks, companies like IBM, Xerox, and Polaroid that were expected to grow rapidly. These stocks, known as the Nifty 50, were seen as one-decision stocks. You bought them and held them forever. But by the early 1970s, the Nifty 50 bubble burst. Many of these stocks were overvalued, and when the market turned, their prices collapsed. Investors learned the hard way that even the best companies can be overpriced. The Internet craze, 1990s. The 1990s brought another speculative mania, this time centered on the Internet. Companies like Amazon, Yahoo, and Netscape saw their stock prices soar, even though many of them had no profits. Investors were convinced that the Internet would change everything, and they were willing to pay any price for a piece of the action. But by 2000, the bubble burst. Many Internet companies went bankrupt, and investors who had bought at the peak saw their portfolios wiped out. The dot-com crash was a reminder that even the most exciting new technologies can't justify sky-high valuations. The firm foundation, theory and practice. So how can investors avoid the pitfalls of speculation and build wealth over the long term? According to Malkiel, the key is to focus on the fundamentals. The firm foundation theory provides a framework for evaluating stocks based on their intrinsic value. Here are the 4 key determinants of a stock's value. Expected growth rate. The faster a company is expected to grow, the more valuable its stock. But growth can't last forever, so investors need to be realistic about how long a company can sustain high growth rates. Dividend payout. Companies that pay higher dividends are generally more attractive to investors, but dividends aren't everything. Some companies reinvest their profits to fuel future growth. Risk. Riskier stocks tend to have lower prices because investors demand a higher return to compensate for the extra risk. Blue-chip stocks like AT&T are considered less risky, while speculative stocks like tech startups are much riskier. Interest rates. When interest rates are low, stocks tend to be more attractive because bonds and other fixed-income investments offer lower returns. But when interest rates rise, stock prices often fall. The random walk theory. Malkiel introduces the random walk theory, which suggests that stock prices move randomly and are impossible to predict in the short term. This theory challenges the idea that investors can consistently beat the market by picking the right stocks or timing the market. Instead, Malkiel argues that the best strategy for most investors is to buy and hold a diversified portfolio of stocks, such as an index fund that tracks the S&P 500. The random walk theory has 3 versions. Weak form. Past stock prices can't predict future prices. This means that technical analysis, which relies on charts and patterns, is useless. Semi-strong form. Public information, like earnings reports, is already reflected in stock prices. This means that fundamental analysis, which focuses on a company's financials, can't help you beat the market. Strong form. Even insider information can't help you beat the market, because all information is already reflected in stock prices. The case for index funds. Malkiel's advice for individual investors is simple. Don't try to beat the market. Instead, invest in low-cost index funds that track the market as a whole. Over the long term, the stock market has provided solid returns, and most actively managed funds fail to outperform the market after fees. By investing in index funds, you can avoid the pitfalls of speculation and build wealth steadily over time. Conclusion. Lessons from a random walk. The history of investing is filled with stories of booms and busts, of fortunes made and lost. The key lesson from a random walk down Wall Street is that markets are unpredictable and speculation is dangerous. While it's tempting to chase the next big thing, the best strategy for most investors is to focus on the fundamentals, diversify their portfolios, and stay the course. As Malkiel puts it, the market is like a giant casino where the odds are stacked against the individual investor. But by following a disciplined long-term strategy, you can tilt the odds in your favor and achieve financial success. So the next time you're tempted to jump on the latest investment craze, remember the lessons of the tulip bulbs, the South Sea bubble, and the dot-com crash. Stick to the firm foundation, and you'll be well on your way to building lasting wealth.